The allure of consistent income streams has captivated investors for centuries. In the modern investing landscape, dividends, those periodic payouts of profits from companies, offer a compelling alternative to chasing capital appreciation alone. Among dividend-focused strategies, the dogs of the Dow has emerged as a popular, yet sometimes contentious, approach. This article delves into the dogs of the Dow ETF, exploring its mechanics, historical performance, pros and cons, and potential role within a diversified portfolio. Unleashing the pack, unveiling the concept. The dogs of the Dow strategy, popularized in 1991 by Michael B. O'Higgins, advocates for buying the 10 highest-yielding Dow Jones Industrial Average, DJIA, stocks annually. Its premise is built on two core assumptions. Value hunting. The DJIA's historical bias towards established blue-chip companies often leads to undervaluation of their high-yielding stocks. Dividend consistency. These large, well-established corporations tend to prioritize consistent dividend payments, offering a reliable income stream. The strategy's mechanics are straightforward. Identify the 10 highest yielders. At the end of each calendar year, rank the 30 DJIA constituents by their current dividend yield. Buy and hold. Invest equally in the 10 stocks with the highest dividend yields. Rebalance annually. At the end of the following year, repeat steps 1 and 2, replacing any underperforming stocks with a new set of 10 highest yielders. This annual rebalancing aims to capture the highest available yields within the DJIA while mitigating potential underperformance by individual stocks. Tracking the track record, a historical performance analysis. Evaluating the dogs of the Dow's historical performance requires consideration of both total returns and dividend income. Total returns. Compared to the DJIA itself, the dogs of the Dow have historically underperformed in terms of total returns. Over the past 20 years, ending December 2023, the DJIA delivered an average annual return of 8.1%, while the dogs of the Dow averaged 6.8%. Dividend income. However, the dogs of the Dow consistently outperformed in terms of dividend yield. During the same 20-year period, the average annual dividend yield for the dogs of the Dow was 4.1%, compared to the DJIA's 2.2%. This highlights the trade-off inherent in the strategy. Investors prioritize income over capital appreciation, potentially sacrificing some long-term growth for a more reliable and immediate stream of dividends. The hunt for alpha, examining the pros and cons. Pros. Consistent dividends. The strategy prioritizes companies with strong dividend-paying histories, offering a dependable income stream. Value investing potential. High-yielding stocks may be undervalued due to market inefficiencies, providing potential for capital appreciation alongside dividends. Diversification within the DJIA. Investing in 10 different stocks across various sectors offers some diversification benefits within the concentrated DJIA. Simple execution. The rebalancing process is straightforward and requires minimal ongoing analysis. Cons. Underperformance relative to DJIA. Historically, the dogs of the Dow have delivered lower total returns compared to the broader DJIA. Limited growth potential. High-yielding stocks may be mature companies with slower growth prospects, leading to lower overall portfolio growth. Sensitivity to interest rates. Rising interest rates can pressure high-yielding stocks, potentially leading to price declines. Tax implications. Depending on individual tax brackets, dividend income may be subject to higher taxes than capital gains. Finding the right fit. Integrating the dogs of the Dow in your portfolio. Whether the dogs of the Dow ETF deserves a place in your portfolio depends on your individual investment goals, risk tolerance, and time horizon. Consider the following. Income objective. If your primary goal is generating consistent income, the dogs of the Dow ETF can be a compelling option, providing a reliable dividend stream. Risk tolerance. The potential for lower total returns and higher tax implications requires a moderate risk tolerance. Time horizon. The strategy may be more suitable for long-term investors who prioritize income over short-term growth. Portfolio diversification. Consider the ETF as a complement to other holdings with different risk and return profiles to achieve a well-diversified portfolio. Beyond the pack, alternative dividend strategies. Active management. Actively managed dividend funds may employ more complex selection criteria and offer the potential for higher returns, but typically come with higher fees. Dividend reinvestment plans. DRIPs. Reinvesting dividends automatically allows for compounding returns and long-term wealth accumulation. Ultimately, the choice of dividend strategy depends on your individual goals and risk tolerance. Consulting with a financial advisor can help you navigate the various options and tailor a dividend-focused portfolio that aligns with your specific needs. Conclusion: unleashing the dividend powerhouse with prudence. The dogs of the Dow ETF offers a simple and straightforward approach to capturing consistent income from established blue-chip companies. While it may not deliver the highest total returns, its reliable dividend stream and potential value play appeal to income-oriented investors. However, it's crucial to understand the trade-offs, limitations, and alternative strategies before unleashing the dogs into your portfolio. By carefully considering your goals, risk tolerance, and overall investment strategy, you can harness the power of dividends to build a well-rounded and financially secure future.